Hi, this is Jim Welsh from macrotides.com. Thanks for tuning in. In recent months, I've had a relatively sanguine view of the U.S. economy and the global economy, primarily because of the bifurcation between manufacturing and services. What we have seen is, to date, the trade conflict has caused a sharp slowdown in the manufacturing sector, but relative to the service sector, manufacturing is a relatively smaller part of GDP. In the U.S., manufacturing is 11% of GDP, services over 80%. For instance, in the EU, Germany is the huge manufacturing powerhouse. Manufacturing is 22% of GDP. And in China, obviously, manufacturing is a greater share. But the bottom line is, the weakness we've seen to date has been concentrated in the various PMI, Purchasing Manager Indices, while the services sector has kind of just chugged along at a decent clip. And when we review what's going on around the world, you'll see that. When you look at the China services versus manufacturing, you can see there's a very wide gap between what services are doing and manufacturing, which is hovering right about the 50 level. In Europe, manufacturing has slowed significantly, and the recent PMI for manufacturing is dropped down to about 46, whereas the service sector PMI is above 53. And the same thing holds true for the United States, where the PMI manufacturing is, I believe, 51.2, and manufacturing is about 53.5. So the spread is pretty wide in all these different countries. However, I think the onset of new tariffs that were announced last week by President Trump, at a minimum means that this trade conflict is going to continue to go on for an extended period of time. And as it does, I think slowly but surely, we will see the weakness that has been contained in manufacturing gradually spread to services. If we look at the global PMI, which includes the U.S., Japan, and Eurozone, you can see it has dropped comfortably below 50. Going back the last 7-8 years, you can see there's a pretty good correlation between the manufacturing PMI and the services PMI for these three major GDP blocks. And what it implies is, as PMI growth continues to slow, which I think it will, under 50, gradually but surely, I think it's going to pull the service sector down. When the Commerce Department announced second quarter GDP figures for the United States a week and a half ago, they also went back, I think, about 5 years and recalculated GDP as well as corporate profits as a percent of GDP. And what we can see is corporate profits as a percent of GDP dropped from 10.7% down to 9.5%. That's 10% lower than what they had previously estimated. So what that means for the U.S. stock prices, they're 10% more expensive than what we really thought just a short time ago. So the bottom line comes, if I'm right, that slowly but surely services start to slow, it's going to have an impact on GDP. I think we're going to see economists cut their forecasts for the second half of 2019 and early 2020. Analysts are going to cut individual stock earnings forecasts. And what we can see is, up until last fall, the estimates for 2019 and 2020 were pretty much on top of each other. But as this year has progressed, earnings have dropped significantly down to about 2% for 2019. They could get further cut. But more importantly, I think estimates for 2020 are about to get hit. And I think as that takes place, the U.S. equity market is going to be vulnerable. Thanks for tuning in. May something good happen for you today.